hello, and thank you for joining me for another TechAdvice.life video. I'm joined by Harry Dent, one of the world's most well-known economists and best-selling authors, whose 1992 book, The Great Boom Ahead, correctly predicted the economic boom of the 1990s, and who has been dispensing highly respected financial advice for decades. Welcome to the program.
Nice to be here, Alex.
So what's the short version of your most astute predictions over the past 3 decades? And is there anything that you got wrong, whether it be in the timing or something else?
Well, I predicted the recession in the United States. I started my newsletter in 1989. And then when the recession happened, I came out with the Great Boom Ahead, and I predicted that boom, and people thought I was crazy. I would say my mantra back then, Dow 10,000 by 2000. This was in the early 90s when the Dow was between 2,000 and 3,000 people. And everybody said, Japan's eating our lunch. We're a has-been. We're a sunset country. And of course, a few years later, it just took off. But my best prediction back then was in my first book called Our Power to Predict. That came out in late 1989. And I said Japan was going to see a 12 to 14-year major downturn and crash precisely when the U.S. and Europe and the rest of the world would see the greatest boom in history. Now, imagine how crazy that sounded, because everybody, like I said, worshiped Japan. Everybody in the U.S. and Europe like, oh, we could just be like Japan. I'm like, no, Japan's baby boom is peaking. That's why they're doing so good. They are copying what we do and doing it better. They're not leading the leading tech industries and stuff like the U.S. is and stuff. So, so of course that was the best thing, because a few people saw the boom of the 90s, not many, but nobody saw the collapse of Japan when they looked like they could do no wrong. And right in 1989, economists were predicting back then that Japan would overtake the United States in 20 years when they had a third of our population, which would have been demographically impossible. So now then we predicted the tech bubble was peaking. February for the internet, just as it's happening, in April, just a month after it started for the NASDAQ. And then the real estate bubble in the U.S. in September 2005, and that's when I was selling my house in Miami and moving to Tampa and renting. I predicted the real estate bubble was about to burst in the United States, and people, again, like, you got to be kidding me. And no possibility. And then, of course, all from the beginning, and in the Great Boom Ahead in all my books, I always said, look, this baby boom trend will last till late 2007 approximately. They'll be spin out. They will naturally turn down, just like the Bob Hope generation did in the late 60s and caused a downturn in the 70s, and in the generation before them, roaring 20s and the 30s. And we'll see a major downturn, and, of course, GFC and all that stuff. Now, here's what I missed the most, and no question about it. When we got this crash that we predicted and all this stuff, and then the stimulus came out in early 2009, which really massive. I said, oh, this will only last a few years. This is just artificial money. The fundamental trends are down. Well, they kept stimulating and stuff. And so I finally reversed my position on that when Trump got elected by surprise. And we were the ones that telling people he's got a better shot than people think, because he understands the all-star wrestling fans, the swing vote, the people who've been hurt by global trade and competition and immigration, and he's appealing to them. And so then I got bullish again. But for a couple of years I kept saying, well, this looks like a top. Well, people like, Harry, come on, get off of it. I mean, governments keep supporting this bubble, and it keeps going. But now the best prediction I've made in recent years, I said, look, the way you'll see know this bubble's peak is when you see a sudden 40% crash in less than 2.5 months. That's when you know it, and it'll just be because something triggers it. It was the subprime crisis in late 2007, early 2008, but it was the coronavirus. I didn't expect that. And the other thing we said, that finally, when the Federal Reserve in September of last year, 2019, this repo crisis came up, the banks all of a sudden, when they tried to take in reserves out of the system to see if the economy could handle it, the banks went nuts and couldn't fund the repos, and they had to step in with massive stimulus, hundreds of billions of dollars. And I said, oh, this is the final orgasmic bubble. Now, my first forecast was this will probably be over by May or summer at the latest. Mm-hmm. Well, the coronavirus comes in and bam.
Yeah.
So I was definitely early, especially between about 2012 and 15, predicting the demise of this bubble, underestimating the central bank's result. I didn't so much underestimate the result. I just thought artificial money just cannot keep this going this long. But man, they did it big time. But now I get the problem that everybody's like, oh, well, Harry, this isn't that 40% crash. This is the virus. No, this is just the perfect trigger. This virus, and I'll go into this virus is going to be over faster than people think. I'm tracking this daily on it like nobody else in the world, using my S-curve ability to forecast instead of just extrapolating with the trends, which all the experts are doing. And this virus is going to be temporary. It's already going to cause a mini depression for months. But we're going to go back down later this year after a recovery, and we're going to see the real crisis that comes from the same thing in all of history. Whenever you have major debt bubbles, like into the Roaring 20s and into the 1830s before that, that's a 90-year cycle, almost like a clock, and financial asset bubbles around them, you will have a big, ugly bubble burst. It'll take 2.5 to 3 years to work out. Stocks will be down 80% plus, real estate 30, 40, 50%, commodities 80% plus, and that is happening. But this is the first crash. There will be a rebound. I think this first crash is about to be over in a couple of weeks at most. One more wave down. I think we may have started that this week. And then we get several months bounce. This happened in the 29, 40-some% crash, 5 months bounce, doesn't make new highs. It retraced 50 to 60% of the losses. And that's what I tell people. If you miss the first one, don't worry. You get out on the bounce. You may only be down 15 or 20% instead of 40 to 50. You get out there, and then you do what I advised before the first one, and that is get into the high-quality bonds, the safe stuff. And there's other things you can do to make money depending on your risk tolerance. But this is now people always pissed at me. Nobody wants to hear the bubble's going to burst because you know why? People are high in a bubble.
Yeah.
Real estate's going, especially Australia. Real estate's going up 15, 20% a year while you're sitting on your couch watching your high definition TV that used to be $5,000. Now it's $600. If your house is going up 20% a year, you're doing nothing. Your stocks are going up 20, 25% a year. You're sitting on your ass, your superannuation for whatever, People are high and they don't want to hear it's going to end, but they always end. And there is no soft, you can do it smarter, but there is no soft landing. And if you think that you can keep printing money and get through it, ask Japan. How long has Japan been printing money and stuff? They're 30 years after their bubble burst. Yeah. Real estate went down 60 to 70%, never bounced. Stocks went down 60 to 70% at first, and then later 80, only bounced halfway back, turning down again, and they will. They'll hit new lows again. You have to deleverage these bubbles. You have to let the debt be written off and restructured. You have to let these bubbles deflate because the bubbles in the debt prevent a recovery.
Yeah.
They keep it from melting down short term, but the meltdown actually works in your favor. So that's my major thing now, Alex, to people is, look, don't think this is just, if you think this is just the virus, this 40% crash, you're going to miss the big show here. And there's going to be an opportunity to make money in the next bounce. Stocks probably go up 30% or more in 3, 4, 5, 6 months. When are you going to do better than that? And then go down for 2 years or more. Boy, if you can be mildly in some index, inverse index funds, being high quality bonds. The 10 and 30-year treasury bonds went up 20% when stocks just crashed 32%. They like deflation. Interest rates go down. They lock in rates at higher levels. So this is a golden opportunity to make money. But the problem is 90-some% of people will not see it. They didn't see this coming. They'll think it's over. They won't see the next bigger one coming. And they won't have any wealth left to take advantage of the sale of a lifetime. And I'm predicting around late 2022, early 2023 stocks and then real estate on a lag. So that's the story. Radical forecast. People say it can't happen. Well, they told me the 40% crash can't happen. It's happening right now. And on Monday before last, just after the Fed had blown the biggest bazooka ever over 3 days, the markets open the next day, go up a little bit and go down 3,000 points, say, no thanks. We've seen this show before. It ain't working. So they said that couldn't happen. And they also said, well, the central banks keep printing money. You lose credibility at some point. The market said, we're not going to buy this anymore. So what they are buying is the fiscal stimulus, but they'll really buy what'll end this short-term crash, which I think we're near, is for people to see that the virus in Italy is already receding. You can't look at the total numbers. You got to look at the daily numbers that have already peaked and going down at the speed of light, which means the total numbers are going to flatten out about a week from now in Italy. A week after that, the rest of Europe. A week after that, New York and most of the United States. This thing's going to be over before you know it. Well, and then the trick is knowing that there'll be a bounce, but it's not going to last.
So what was it in your youth that sparked your interest in the field of economics, which you obviously capitalized on so incredibly in the decades since?
Well, my father was a political strategist. He was the guy that got the first Republican president elected in decades since Eisenhower, Nixon, against the Democrats by helping him carry the South, who consider themselves Democrats. But he said, you're not Democrats, you're conservative. You should be Republicans. And he got Nixon to carry the South and win for the first time, and of course, Republicans stayed in ever since. Well, he was like me, big picture, strategic thinker, see the forest for the trees, love that, good communicator, all that sort of stuff. But he was in politics. I hated politics. I went to that 68 Republican convention and almost puked the whole time. Such a crazy people, childish people. Ugh, my God. Okay, but I meet my first wife. I get married.
Yeah.
And I meet my father-in-law. He's in Palm Beach. He inherited money, but he was not spoiled by it. He was a private investor out of his own house in Palm Beach, buying land around Disneyland when they did it, buying stock, and he got me into cycles. He got back then, this was in the 70s, late 70s, all these gold bug people were cycle people. They're talking about the Kondratiev waves and cycles and inflation and stuff, and that's when I'm like, I love that stuff. I had a professor who just died earlier this year, 94, finance professor. He also had an eye for cycles. When cycles were presented to me, I'm like, I just clicked with that. I started studying that ever since. I started with the Kondratiev wave, and then I went to Harvard Business School, and then I got out of that, work for Bain & Company. And what did Harvard Business School and Bain & Company teach me? The 4-season, 4-stage model of business, all technologies, all products, all things move in these models. And the reason Bain & Company, we were consulting to Fortune 100 companies, and the problem was always a company had been successful for doing something right in the last season. The season changed, and now they're doing the same thing and failing, and they don't know why. So I ended up, the first thing I came up after years of research was this 4-season cycle. I learned to predict boom and bust cycles from demographics, generational spending. You know what? I didn't learn that at Harvard Business School or Bain & Company. I started doing the same consulting to new ventures in California, consumer ventures, not high tech. And I saw the baby boom coming through their eyes. They were appealing to young baby boomers in the early 80s back then. My Fortune 100 clients at Bain & Company were appealing to the old dying Bob Hope generation. So I started studying the baby boomers. Oh my God, there's more of these people than ever, largest generation in history, and they're going to come in and drive all this stuff up, including the economy. So I nailed demographics. It took me years, studied everything about demographics. And then over time, when one thing after another thing I missed, by the way, and it helped me get a new cycle after demographics. When the tech wreck came, we predicted the top in tech, but I saw the demographic trend so strong that I thought it'd be 20, 30% correction. It ended up be 70%, 78% for tech stocks and like 40-some% for the general market. So I really quickly got into, technology and bubbles and stuff. And so I came up, though, with a geopolitical cycle. I dug and dug. I said, well, when the crash happened, I predicted when it would turn around in October 2002. But I predicted that the markets would go bubble again. And they only had a more normal boom, a mild bubble, because 9/11 changed everything. So then I dug and found geopolitical cycles, 17, 18 years positive, 17, 18 years negative. Could track it back almost 200 years. Well, that changes the valuations of stock. It didn't change the fact that we would still have that 2002 to 2007 boom in stocks. It changed that they wouldn't go as high, they wouldn't get as overvalued as they did in 2000, and like they did again in 2019. So I kept adding cycles, and the cycle that's most important now, I got about 6-7 years ago from my co-author, Andy Pancioli in London for Zero Hour book. He kept saying, he's a cycle guy, and we have a lot of similar cycles, but he kept stressing me 45 and 90-year cycles, WD Gann, and they're like, he said, those are the most important. I was always looking for a technology cycle and couldn't quite get one. When he said that, I went back and looked at my stuff, bam, steamships, railroads, automobiles, jets, and transportation, 45-year peaks and bubbles running after another, like, oh my God. So that, so I just kept refining my research. I'm a cycle guy. And I got inspired there in college. I was literally junior year in college, right after I got married, all came together. I've been studying cycles ever since. And you know what? I've got a PhD in demographics and cycles. And I learned way more from working with entrepreneurial businesses that are creating the future than Fortune 100 to the past, and way more in my entrepreneurial consulting and my own research than I learned at Harvard Business School and Bain & Company, but I learned a lot from both.
Now, you've got a free and live online conference in Australia that's starting on Wednesday, the 8th of April, from midday to 2 p.m. Sydney time. You've got 1,000 places, and people can register at harrydentlive.com. And, I've seen the list of topics. You're going to talk about real estate, depressions, gold, Bitcoin, the virus, stock market, a lot of the things you've been speaking about, obviously. But, tell us about your co-speaker, Sean Allison, and after that, what are the top 3 things that you really want people to walk away from after having seen that event, besides, whatever offers you make and whatever else that people will learn at the conference?
Okay. Yeah, great. Sean, and I've been touring with Sean for years around Australia. Sean, what we normally do in Australia, we do live tours. We'll have 2 days in each city. I'll speak 3 times and do a Q&A at the end. Then we have a number of speakers, all in alternative investments. Buy and hold died after the tech wreck. Ever since 2000, anybody just buying and holding stocks has been whipsawed to death. From 83 to 2000, the best part of the boom, fine to do that. So Sean is an expert in he has a simple options trading system that he's refined. You have no chance competing against the big boys in options and short-term trading. I tell people who want to start an account and trade on the side, a discount brokerage firm, just donate the money to charity and get your tax deduction now. You have no chance. He knows how to do this. He gives you very targeted stuff, targeted risk, exactly when to get out, and it's not that complication. But especially when you're just buying options here and there. So he shows people how you can take a portion of your money, and you should only do this, a portion, and invest it and take advantage of volatility. These strategies work better when markets are volatile rather than when they're steady. In this bubble boom, any idiot could just buy the top tech stocks, and hedge funds can't even beat the FANG stocks and the NASDAQ these days. So things are changing. So I'm going to speak, give an overview of the economy, short-term, long-term, how to make money in the downturn, but more important, where to position yourself in the next upturn, because the next boom is not going to be like the last one. It's going to be far more targeted in countries and regions that do well and investments that do well. In the 83 to this boom, 83 on, you could have made money, real estate, commodities, stocks, anything. It's going to be more focused next time around, because a lot of the world, demographic, they're dying. Japan was the first to die. Every developed country is following them. Australia is one of the few that has positive demographics for decades ahead. Very few developed countries in Europe, United States, all of East Asia, none of them have that. So the world's going to be different. Emerging countries are going to reign. and the best developed countries like Australia are going to do well. And if you sit and go back and buy Japan or Europe, you're going to be disappointed. And even U.S. unless you're in aging industries.
Can you just move your camera down a little bit because you sort of bang the table every now and then, and that's it. And sometimes you get excited, which is good to see. You got passion.
That enough?
No, that's fantastic. So I always have three questions that I like to ask at the end, and one is about the future. So what do you think the economy will look like in 2025, 2030?
Okay, we're going to be coming out of the greatest crash and depression, the first depression since the early 1930s, something nobody expected, something government said they would prevent at all costs, and they didn't. Who will be leading will be India and Southeast Asia. The world will have soured on China. China not only blew up, failed to be the supply chain once we depended on them, they overinvested, over-leveraged their economy, collapsed. And not only was the world dealing with China for supply and buying stuff from them, they were investing in China. Oh, it's the best. It's the new emerging country. China was the biggest boom in modern history from 1983 up until recently. Well, people are going to say, China's kind of peaked out. China overdid it. Where's the next big thing? Oh, it's India. Higher population, ultimately. Demographics pointing up strongly into the 2050s and 60s, while China is declining. Underinvested in infrastructures, unlike China, needs investment. India and Southeast Asia will lead the world out of this, as will the entire emerging world. Europe's going to be coming out kicking and screaming, lagging, especially Southern and Central Europe. Scandinavia will do better. Australia, New Zealand, and in the Pacific hemisphere will be leading with stronger demographics and exports to Asia, particularly Southeast Asia and India. U.S. will do better than most other developed countries, better than Europe. Japan will never come out of this. East Asia, their demographics, along with Europe, are the worst. So it's going to be an emerging world with the U.S. still the leading country. China didn't pass us because nobody saw the big downturn and how much they cheated on the way up. China will eventually come back, maybe around 2025, 26, mid-2020. But most of the world will start to recover more in 2023, led by those factions. So you have to focus your investments more in aging countries like the U.S. and Europe, then aging sectors, cruise ships, pharmaceuticals, vitamins and skincare, assisted living, nursing homes will be on a tear because the baby boomers are still a much bigger, powerful wave than the millennials. Well, millennials and this and will be buying starter homes and stuff. But I always say follow the boomers. And, of course, India and Southeast Asia. And there will be a commodity boom. Commodities will crash. Already they've been down here recently, but they will be even lower, down 80% or more. And then there'll be a commodity boom because who buys the most commodities in the world? Emerging countries. Out of the emerging countries, who spends the most on gold? India and China, Asia, they love gold. But the biggest thing is that emerging countries spend a much higher percentage of their incomes on commodities than developed. So the commodity bust will turn into the next great commodity boom. And the best sectors in commodities in a boom like that, they'll all do well, like they did from the 80s into 2008 before that peak. But the best sectors are always energy and the metals like gold and precious metals and tin and copper and all those things and nickel because they're limited. You can always grow more crops and cattle. You can't grow more gold. So that'll be the whirlwind. Strong commodity boom, Asia leading. There's also, in my long-term research, very clear cycle. When the Industrial Revolution started in the late 1700s, early 1800s, guess who was king of the world? By far, richest by far, most invented most stuff before we did, including gunpowder and all types of stuff. China and East Asia. Well, they fell in the Industrial Revolution, and Europe and the U.S. and then Australia, New Zealand, the English, the Western world rose. Well, starting in 83, that cycle peaked for us, and guess what happens? China, following Japan and other small countries, becomes the leading country in Asia, and now India and Southeast Asia follow, and other parts of Asia, towards the Middle East. So it's going to be an Asian era. This century is going to be Asia. It started in the 80s. It's going to be Asia, and eventually China's going to finally surpass the U.S. when they recover, maybe around 2035 to 40, but only then. And then India, 2050 or 60 on, is going to pass China. India is going to end up later in the century with 1.6 billion people versus China's waning 1 billion. Huge population lead. I can project today with urbanization versus GDP per capita, one of the most predictable things in the world that nobody understands, that India is going to be richer than China and bigger in population and is going to be the leading largest economy in the world by far. And so where do you want to invest coming out of this? India, Southeast Asia, Australia, and in developed countries, aging industries in particular. And that way you'll benefit. If you just spread your world around the developed country, you go back and buy Europe and Japan and US and blah, 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 and a bunch of mutual funds, you'll do mediocre in that next boom. You got to be in the emerging countries and in the aging industries and developed.
And you're given,
and in commodities.
Yeah, well, I was going to say you're giving commodity gold bugs and the commodity lovers some hope there with a buying opportunity when it falls. But what's your quick snapshot on cryptocurrency and Bitcoin and the like?
Okay, yeah, very interesting. I've spoke to a number of conferences here because a lot of the crypto people moved to Puerto Rico, where I'm at, because of tax advantages, and they want to use it as an experimental place, which I don't advise, frankly, but I won't get into that. But I tell the crypto people, you are the next big thing. Otherwise, you wouldn't have had such a big early stage bubble. This is exactly what happened to the internet. The techs were bubbling all in the 90s, but the internet only came in 99 and early 2000 at the very end and drove the last part of the boom. Now, you got to remember, cryptos are not a part of the NASDAQ today because they do ICOs. They're in a whole different market. But the internet bubble was huge, and then it crashed 95% when the tech stocks went down 78, crashed, wiped out most companies, but the Amazon survived. You could have bought Amazon. Amazon went from 6 at its IPO into the bubble top to 163, I think it was, and then back down to 6, and then went to 2,200 or something recently. I mean, so cryptos are a huge opportunity. They are going to crash again. They already had, I think, their bubble peak. I thought they might have one more with the stock bubble here recently, but they did not enough. They're going to go down all the way. They're going to end up, Bitcoin's going to end up, I don't know, between 1 and 2,000. And then I'm interested in buying the survivors. Most .com companies are BS. Coins you'll never need, coins for everything, blah, blah. How many .com companies do we have? Pet.com, Webvan, things that may have succeeded later. So what happens it's called the hype phase. In new technologies emerge when old ones are maturing and usually in a bubble. So the bubble mentality says, oh, here's the next big thing. Wow. And they value them to the moon when it's going to take 20 years to get there. So I tell the crypto people, you're the internet. Think of yourself as the internet on about a 20-year lag. You're in the down phase of the hype phase. And then from about 2022 into the next boom top around 2036, 37 globally, you're going to be the hottest thing in town. And that'll be a sector of technology. Hey, biotech's going to do well, 3D printing, nanotech, all types of stuff. But this hype bubble is telling me, like the internet back then, that the biggest single sector in technology will be blockchain and cryptocurrencies around it. But the real theme is not so much the crypto, it's the blockchain. What blockchain does, in a sentence, is it digitizes all money and financial assets and makes them easily tradable, easily transparent, and easily manipulated. That is going to do for assets of value and money what the internet did for information and communication. It is a big deal, but it's going to fall on its ass first.
So 2 last questions. The second last one I'm going to customize for you and say, what is the best piece of advice that you've ever received in life to help you create the dent in the universe that you so clearly have?
Well, the best thing I got from my father-in-law, he said, Harry, understanding cycles is the most important thing. It's the only way you can see the future because people just go with the trend and don't realize when it's going to change. And the bottoms are the best opportunities, and you get killed if you don't get out near the tops, like Joseph Kennedy in 29. And he said, and the reason he said was because people don't like the down cycles. People want a zip line to heaven. They just want to get better, better, go to heaven, stay there. Well, that may happen in heaven. Doesn't happen here on earth like that. So he taught me that cycles is the most valuable. You just have to not listen to people about it. And that's where you go. And then he also said, you always have to look under the surface. He always gave me the iceberg analogy, where people look at the tip. Well, that's the iceberg. No, 85% of the iceberg's below the surface, and that's what sank the Titanic, not the tip, the iceberg below. And again, my wife's a leading psychotherapist. Same thing there. People look at their mind. Your conscious mind is 10 to 15% of what's going on and driving you. 85% of it's subconscious. Suppressed things from childhood, and unconscious, your genes, hardwired. If you don't look down there and understand what's really driving you, you're not going to understand why you do the same things over and over again and get the same stupid bad result in many cases. So looking under the hood, and understanding that you can't listen to people and say, oh, cycles don't matter. Oh, and that was the past. The technology people are famous for that. Oh, we don't have cycles anymore because technologies grow exponential. Technologies have always grown exponential. They also have the biggest bust, if you haven't seen. They go exponentially up, exponentially down. So really the insight that if you don't understand cycles, you cannot see the future, especially at the most important time. I got that from my finance professor and my father-in-law right off the bat. That one I didn't get from my father.
So besides telling us to go to harrydentlive.com and signing up for your conference on the 8th of April at midday Sydney time, what is your final message to the viewers and readers who are looking at you right now?
Well, again, always get the big picture. I mean, the whole point of this webinar, and it's free because it's so important right now, you've got to see the big picture. The virus is not the main theme here. The greatest bubble in history, the most obvious thing. If you look back at the stock market, since stock exchanges started in the late 1700s, which, by the way, the same time free market capitalism started with Adam Smith, 1776, his first book. The steam engine patented 1776, the seed of the Industrial Revolution, and democracy. The Declaration of Independence, all in 1776. Talk about cycles coming together, you know? So we're in an unprecedented time. Ever since then, we've had explosion in population, standard of living, just since the late 1800s. Our standard of living has gone up 8 to 10 times in developed countries. Our life expectancy has gone from 30 to 70 in emerging countries, 40 to 80 in developed countries. More than all of human history for hundreds of thousands of years combined. We're in a huge time of opportunity, but in that, everything's also cyclical. And we're in the biggest cycle. You will not see, if you look back at that stock chart, it will be crystal clear. And I have that in my presentation. 1837 peak, biggest bubble in history up until then. 1842, biggest crash, especially real estate. 1929 to 32, 90 years later, bottom in 32, next depression and biggest crash ever. And now here we are, 2019-20, peaking, looking at 2022. Those bottoms and those tops, the bottoms are exactly 90 years and the tops are within. This is obvious if you look at history. I'm here to give you clarity in a time of extreme confusion. Is this a bubble or not? This is a bubble, damn it. Looks like a bubble, quacks like a bubble, walks like a bubble. It's a bubble. People say, well, blah, 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 but da-da-da. No, da-da-da. This is a bubble. You know what a bubble looks like, Alex? An orgasm, the male orgasm. It goes up exponentially, goes, boom, and then it's over. There is no soft landing to the orgasm. When men are done, they're done. The women want to smoke a cigarette, talk, hug. No, men are done, okay? It is a big financial orgasm. They're obvious. Everybody says, oh, it's a black swan. That's an excuse for people that don't understand cycles in history. People don't understand cycles in history. I'm urging you, listen to me. I've done my homework. I've studied bubbles. I've studied cycle along with my co-author, Andy Pancioli, a 0 Hour book. We've studied it more than anybody in history. We can guide you through this. We won't be perfect because the short term always has twists. This virus is an extra twist. But I'm on this virus like a fly on you know what. I'm telling everybody exactly when this is going to slow down in different countries. Everybody else is just doing the curve. I'm looking below the what? Below the hood, below the surface.
Yeah.
So that's it. And we've just separated from our publisher in Australia and US, but we have a free newsletter, harrydent.com. You can get on that. And then later in April, we're going to recreate our newsletter under our original name, HS Dent Forecast. Get on my newsletter. The free one's free, but even my newsletters are very affordable. You need a guide. You cannot. Here's the thing. Do not listen to economists and politicians who, just like Trump and this fire, don't want you to panic, don't want you to do the wrong thing. And do not, for once in your life, because most of the time they're right, do not listen to your financial advisor now. They'll say, oh, just diversify. Oh, and stocks will go to new high. You know when stocks will go to new high? When you and your financial advisor are dead, if ever. 29p. You know when stocks got back? 54. Manhattan real estate, like the Shanghai back there, went down 61%. You know what I got back? 53, 24 years later. And we don't even have the demographic trends in developed countries to maybe even get back there. So this is a time you have to get safe for a short period of time. Don't do the conventional thing. Hey, if I'm wrong, you're going to know. I'm telling you, if we do not see a major crash and downturn by the end of 2021, I know what I'm saying, it'll go till 2020, 2023. I'm going to be a limo driver at the Gold Coast, okay? I'm going to quit because I'm that convinced of this.
Yeah.
This is baked in the cake. It's not a black swan. If somebody's calling a black swan, do not listen to him. Black swan means, I don't know what I'm talking about. So that's my excuse. This was a black swan. I had a good friend made a friend of my wife's friend. And he lost everything in the GFC. And he said, Harry, nobody could have seen that coming. And I'm like, I did. Not a black swan. He was in bubble land. Of course he didn't see it coming. So that's the leave it. You got to understand, learn what I learned early on. You got to understand cycles. You don't have to like them. And you know what? The winter season is the most opportunity if you see it coming. The winter season creates the greatest. The downturns create the greatest innovations, not the booms. People get complacent. Success creates failure, and failure creates success. That's cycle. Success makes you complacent, like Henry Ford in 1929 when General Motors passed him forever. You know?
Yeah.
And failure wakes you up and makes you relearn and reconsider and makes you successful again. So embrace it. Embrace cycles. And don't listen to people right now. I'm telling you, don't listen to Warren Buffett. Don't listen to Donald J. for Genius Trump. Don't listen to these people. Yeah. Warren Buffett is great most of the time. He doesn't know his you-know-what from a you-know-what. Right now, he's going to lose his ass as well. He's in all large cap stocks that are overvalued. Yeah. Even if you pick good ones, they're going to go down. He might just be down 70 instead of 80. Yeah. Don't listen to him either.
He's got the billions; he can afford to lose them and still bounce back. So most of us are not like that. Well, Harry, look, thank you so much for your time today. I'm sure you have plenty of other interviews. I'm going to be there on the 8th of April watching from my computer screen, and I really look forward to learning a lot and hope I can talk to you again in the future.
Yeah, I look forward to it again. Again, harrydentlive.com. That's simple. It's free.
Thank you very much. Bye-bye.